Hello. We're going to look at question 4 from the March-June 2021 exam from the ACCA Strategic Business Reporting. If you haven't, you might want to pause this recording at each stage before each part of each question, just to make sure you understand the scenario and have done your own plan before listening to the recording. The first requirement, and it did say for that there was no need to refer to any exhibits, was to have a bit of a discussion. And the discussion again, well, you can see it on the face of the question, can't you there, is about the importance of, again, sustainability, again, in investor analysis, and this was worth 4 marks plus 2 marks. The 2 marks are so-called for style and professionalism. So if you manage to get a couple of subheadings in, then that gets you 1 of the 2 marks. The other one will depend on how you write. Maybe you get it, maybe you don't. This is an example of a current issue being examined. So we don't see current issues being examined for 25 marks. We see them for 4 marks. And again, even if you've done no reading around this, I think we'd be able to put something together. I can't really add much to what's in the answer, but when you're having that discussion again, ultimately at the end of the day, so again, it's really a question, isn't it, about do investors pay attention to, well, think about sustainability is probably 2 things, isn't it? It's to do with the environmental conduct of the business, and also its social conduct. So those 2 together, environment plus social equals sustainable, at least in my view. So you can have a little bit of a discussion about that. And I guess most people would come down the lines of agreeing with what the examiner said. There's no point in making trouble by saying that no one pays any attention to it at all. You could perhaps have a little bit of an argument about some investors if you want to. Again, you might be able, in terms of ideas, it's not really a knowledge question, is it? Again, well, things like using some of the words like the characteristics of financial information might help. So you've got words like relevance. Do they find it difficult to get information that's comparable? You may not find this very able to put all of these points in. But so in addition, integrated framework might be a possibility. So integrated reporting. Just showing a little bit of knowledge there that you understand that this becomes much more of an issue for companies now than it was maybe 20 years ago. So can't really add any more value than that. The second requirement was then to have a look at a specific scenario and to look for impairment events or impairment indicators. If you need to, pause the tape for a couple of minutes while you have a read of that scenario again and just see if you can see the impairment indicators there. When you read the scenario, you're almost saying, aren't you, Mama, I've come home. Because what's happened is there's been a natural disaster. As a result of that, the non-current assets have been destroyed. Have a mark. The share price is down. The point about the share price falling is that it may even fall, again, in some cases, below the value, around the value of the net assets, in which case maybe even net assets are overstated at the moment. So all sorts of possibilities there. And again, it also talks, apart from the non-current assets being destroyed, it also talks about the manufacturing facility. It also talks about the reputational damage. So again, decline in customer demand. So as long as you're aware that IAS 36 says any impairment scenario starts with looking for impairment indicators, it's a very straightforward question. After that, we were then asked about a big block of accounting. As we get into these accounting questions, it's useful, I think, to just highlight the year end, which was the year ended the 31st of December 07. It was broken up into a number of points. The first one, which was for 4 marks, was to have a look at the destruction of assets, and also, again, the decommissioning of the power plant. The key thing, isn't it, is lots of subheadings to make sure you don't miss out anything. So some assets were completely destroyed, and some, the power plant, is going to be taken out of action at an earlier date. So 4 marks in total for this. Destruction of assets. If you have no asset, well, it'll be impaired down to 0, won't it? If I did have an asset and now I don't, they are actually then being taken out of the books. So you could either use the word impaired to 0, or you could use the word derecognised. The key thing is that there will be a loss, clearly, and those losses will go to profit and loss. Remember, the whole exam is explaining things and telling the directors where to stick things: balance sheet, profit and loss, or OCI. The decommissioning of the plant, well, when they set up the plant, they will have set up a decommissioning provision. They'll have debited PPE and credited provisions on the assumption that there was a legal or constructive obligation, which there must have been. So the plant is now going to come out of use at an earlier date. So in the balance sheet at the moment, we don't know I don't need to write exact figures. You've got a figure for PPE, and you've also got a figure for provision. The impact is the PPE will now be depreciated over a shorter period. And secondly, the provision value will change because the provision will be settled in 8 years instead of a much longer period. If you've got to pay it in a much earlier date, the provision will therefore get bigger. Remember, the provision is added to the value of the PPE. So initially, they may be added a provision of 10 onto PPE. Perhaps that provision is now going up to 15 or whatever. So the message is that they will have to, number one, adjust the carrying amount of the provision and the PPE. It will go up because the life of you're going to have to settle this in a much earlier date. So these two figures will increase. provision will go up by, say, 5. The PPE would go up by 5. We'll just say that hypothetically. Why? Because the provision will be settled earlier. It will now be settled in 8 years instead of 25 years. Secondly, the plant itself will now be depreciated. The new carrying amount of the plant will be depreciated over 8 years instead of 25. So the other point, isn't it, is that we will depreciate the plant over 8 years, not 25 years going forward. Is that advanced level knowledge? No, it isn't. So that's something, when you did the lower exam, if you'd seen that question, you'd have said lovely. So it's not really an advanced level topic, is it? But clearly, everything from the lower exam is in our syllabus, and particularly stuff like this, because it's so important. The second question then asked us about 2 further things. One was that some environmental damage had been caused, I believe, by this disaster. Yes, there has been some damage caused by the disaster. So we were asked to think about the cost of the damage. This is more to the environment, isn't it? Caused by the disaster. And also about some government compensation. Again, this was for 4 marks. They're like tiny 2-mark questions, aren't they? If you agree to pay some money for some damage that you've caused, so this is my chimney, there's a disaster, it falls over again, doesn't it, and kind of damages some property next door. Is this something for which I have to make a provision? Well, I only make a provision, remember, so you would only recognise a provision if there is a legal or constructive obligation. Remember, a constructive obligation arises from past practice. So if in the past you've always sorted things out, if you've polluted people's streams, that would be a constructive obligation. In this scenario, it does say that they have only repaired minor damage in the past. So probably you might say, well, I don't think we would set up a provision. However, this is another issue where it might be marked right either way, because it did say that they've always, it depends how you read it, doesn't it? You might say, well, they've repaired in the past, they'll repair in the future. The examiner says there's probably not enough evidence there, no provision. However, you could have an argument about that, and I would certainly give you credit. So again, unlikely to recognise a provision. But it's not the red words that matter. The people who come down in this exam are the people who don't have the blue words, the words about when you recognise provisions in the first place. Government compensation is about asset recognition, isn't it? And remember, when you're thinking about asset recognition, there are 3 degrees of certainty. With assets, things are either virtually certain or probable, or possible. That's one of the most basic things in accounting. It goes back not just to the last exam you did, but the exam you did before, I think. So to not explain that would be very, very embarrassing. So when we look at this, if something's virtually certain, then as you know very well, you'd recognize an asset. If something's probable, you'd disclose it. It's called contingent asset then, isn't it? And if it's possible, you would ignore it. Based on the scenario, I think it sounds to me all that's happened is they've had something from the government saying, thank you for your application, we don't know. So I think it's just a possible asset. Therefore, again, it would be neither recognised nor disclosed at the moment. Now this one, so the cost of the damage caused by the disaster you can perhaps argue about. You can't argue about this. This is possible. So it would neither, would it be recognised nor disclose. Highly embarrassing to get something like that wrong. Very basic accounting. Now that leaves two parts. Part 3 about the aluminium commodity price. Well, you'd probably have said, well, I'm not going to do that yet. And you'd have been right, I think. So we'll talk about that in a bit. But exam technique says I would probably just do part 4 first. Part 4, just have a quick look at the requirement again. And I have to say, well, it's almost the same as the last question, isn't it? Because the last one we talked about, this is money now from the insurance company, not the government. And you might say, why repeat the question? He repeats the question because it's something that affects businesses. Businesses are not affected by very obscure accounting rules, but they're affected by this. So, would I write out the asset recognition rules again? You bet I would, otherwise I've got nothing to say. So I would start out by just once again explaining the asset recognition rules. So it's this thing again. And then apply to the scenario. And when you read through the scenario, the feeling I got from reading about this insurance policy was it sounds like the loss on the non-current assets would be paid. So the loss on the non-current assets will be paid, or it's likely to be paid, isn't it? The other losses, so this is the relocation costs and the revenue lost, the lost revenue. Well, the loss on the non-current assets, let me just get rid of those words. We're saying, aren't we, that that seems to be virtually certain. So the loss on the non-current assets is virtually certain. The other things are either remote or possible. So the loss on the non-current assets, I would recognise the asset. These would be ignored. You might be wondering where the 280 has come from that's mentioned in the answer. In an earlier part of the scenario, the examiner did give you the fair value of those assets, which is probably what the insurance company would pay, but I don't think I'd have made that link as a candidate. And that finally takes us back to the bit I missed out before, and that's this requirement 3, which was something to do with hedging, or specifically to do with hedge accounting. So if necessary, pause the recording and read the paragraph again. It says that the client is worried about the price of commodities like aluminium. So they're worried about the price of aluminium, okay. And they're worried about, they've called the transaction highly probable. And you may be saying, well, I'm not sure what that means. But the transaction is no longer highly probable. So this again was worth 4 marks. I'm not going to answer it in the conventional way because we can just use this to talk about hedge accounting a little bit. So I'll talk about some stuff that's not relevant here. There are 2 types of hedge accounting in your syllabus: fair value hedge and a cash flow hedge. A fair value hedge accounting is relevant to a business that is concerned about the fair value of, let's say, a recognized asset. You're worried about something that's in the balance sheet and you are worried about its fair value. That's the concept of the fair value hedge, and you go into a derivative transaction. It's not relevant here. And the reason that you'll see it's not relevant is when you've sorted out the definition of a cash flow hedge. A cash flow hedge is when you are concerned about cash flows from highly probable future transactions. Now, that's not come from me, it's come from the standard. And to me, it's the minimal level of knowledge, but even so, we're almost in prize winner corner here. So, you used cash flow hedge accounting not because you're worried about something in the balance sheet, but you're worried about something that would happen in the future. Now, the word that he put in there was highly probable, and that was to make you think, to make the link with cash flow hedge accounting. So actually, the one on the left is not relevant. It's the one on the right that's relevant. And when you are worried about a future transaction, basically the rule is that you're worried about the price of aluminium, so you enter some derivative transaction. It doesn't matter whether it's called future forward option or swap, it's just a derivative. But the key thing is that normally gains and losses on derivative transactions go to P&L. However, if you are doing a cash flow hedge, gains and losses, again, on the derivative, go to OCI. They're put there temporarily, and basically, when you get to the day when you come to buy or sell the aluminium, they recycle them to P&L. Let's not worry about that. But that's the point that was being tested here, or that you were supposed to have to get the understanding. So if you're worried about these things, you can apply cash flow hedge accounting. Derivative gains and losses go to OCI. If, however, you recognise, as in this scenario, that actually the purchases are no longer highly probable, you have to stop hedge accounting. And that means, again, you'd have to put the gains and losses in the P&L. So if your brain is 6 watermelons plus in size, you could measure it with a tape measure later. Again, in this scenario, again, so the phrase is that, let's see, the transaction is no longer highly probable. So basically, you cannot use cash flow hedge accounting and therefore gains and losses will go where they normally go with derivatives, and that means they go to profit and loss. There's a review of question 4. If you look back through the whole exam that we've talked about, what was hard? 3 or 4 marks of the pension question were hard in question 1. I think people will have got in a muddle because of this reference to bitcoins in, I think, question 2. Clearly, this hedge accounting was beyond most candidates. But that, if you add those 3 together, maybe you're left with another 88 marks. And the other 88 marks, I cannot see why we could not get virtually all of them, as long as you've turned up, again, with the knowledge of the basics in this exam. Remember, on the OpenTuition website, we've got a number of flashcards which you're free to use, and they're a great way to test your basic knowledge. Thank you very much for your company over the last period of time. I hope you found the debrief useful. Thanks, and bye for now.